and today I'm going to be talking to you about why you should be trading as a business. But as you're listening today, there are a couple of things that we ask you to keep in mind. The first is that tax law is changing constantly. We do make every effort to keep this presentation as updated as possible, but before you rely on the information I present here to make a decision, we do recommend consulting with either a tax accountant, like Traders Accounting, or a tax attorney. The second thing that we ask you to keep in mind is that Traders Accounting is not a law firm, so none of the advice given here should be considered legal advice. What we are is an accounting firm, and for 16 years now, we've been helping traders really with all aspects of trading and taxation, including helping traders set up business entities to use for trading to really maximize their tax savings, their tax preparation at the end of the year for both their trading entities as well as personal returns, monthly bookkeeping throughout the year, coaching to ensure that they're operating their business entities properly, as well as helping traders set up self-directed 401ks to help with their retirement planning needs, and revocable living trusts to help with their estate planning needs. And we really try and live up to our motto, you trade and we do the rest. If you'd like to find out more about Traders Accounting, about what we do and our services, we invite you to check out our website at www.tradersaccounting.com. Give us a call at 800-938-9513. Email us at learn@tradersaccounting.com. And we also invite you to check out our blog, the address of which is at the bottom of the screen. I like to start these presentations by taking a look at this quote from Judge Learned Hand. And it says that anyone can arrange their affairs so that their taxes shall be as low as possible. You are not bound to choose the pattern which best pays the Treasury. There's not even a patriotic duty to increase one's taxes. Over and over again, the courts have said that there is nothing sinister in so arranging affairs as to keep taxes as low as possible. Everyone does it, rich and poor alike, and all do right, for nobody owes any public duty to pay more in taxes than the law demands. And I like to start with this because it really sums up just what we do here at Traders Accounting. We help traders arrange their affairs so that their taxes shall be as low as possible. And when we talk about trading as a business, we're talking about it from a tax perspective, trading so that your trading activities are taxed as a business. And we do this for two reasons. First, by trading as a business, you will end up paying less in taxes, leaving you more cash to use for trading purposes. And so by doing this, it allows you to see more profits from trading and to see those profits sooner. I like to use the metaphor of the two paths to profit to talk about trading tax as a business. On the left, we have trading without taking any special steps to improve your tax situation. And you can certainly make a profit by doing so, but you're going to be paying more in taxes, and along the way, you can run into some pretty serious issues with things like the $3,000 capital loss limitation and wash sale rules, both of which we'll get into in more detail a little later on. But this path on the right represents trading inside of a business entity, trading taxed as a business. By doing so, you'll be able to deduct more, leaving you with more money to trade with, and you'll also be able to take steps to really remove yourself from those serious tax issues, that $3,000 capital loss limitation and the wash sale rules. And so today we're going to talk about just what that path on the left looks like and how to get from that path to being taxed as a business and paying less in taxes. So it's a pretty basic fact that taxes are your single largest trading expense. As you make more in profit, your tax bill is going to increase. But even in years where you have losses from trading, taxes remain your single largest trading expense because you can be prevented from deducting those losses in the year where you actually take them. And so for every dollar you can write off, for every deduction that you can take against your trading profits, this is going to leave you with more money to trade with. And so by trading taxed as a business, you really can maximize your cash flow, and by doing so, maximize your ability to generate profits. So to talk about how to be taxed as a business and how to improve your tax situation to be taxed as a business, first we have to talk about just how the U.S. tax code is applying to traders. And there are really two tax codes in this country. There's the individual tax code and then there's the business tax code. And both of these are legal and available for you to use. You simply decide which one you'd like to apply to you, and then make sure you take the steps necessary to ensure that you are qualified to use that method of taxation. And so being taxed as a business allows you to take really some substantial deductions. And our clients typically see between $7,000 and $35,000 per year in deductions related to trading that, if they're being taxed under that individual tax code, would be disallowed by the IRS. So being taxed as a business is a pretty huge advantage. And in order to determine if your trading rises to the level of a business, and really if the IRS is determining if anything is going to be taxed as a business, they apply what's called the economic performance or all events test, which is exactly what it sounds like. The IRS take a look at really all of the events and circumstances surrounding your activity, and based on those factors, decide whether or not you are entitled to be taxed as a business. There are 10 specific factors that they like to use when making this analysis, but they really can go pretty broad when they're making this determination. In one of my favorite tax court cases, the IRS was challenging a husband and wife who had retired and were operating a dog breeding business in their retirement. And in the tax court filing, the IRS alleged that they couldn't possibly be carrying out a business because they were having fun while doing it. Thankfully, the tax court shut down that particular rationale, but it does show just how broad this analysis can be. But the 10 specific factors that they typically use are whether you carry on the activity in a business-like manner, whether the time and effort that you put into the activity indicates that you intend to make it profitable, whether you depend on the income from the activity for your livelihood, whether your losses are due to circumstances beyond your control, or if they're normal in the startup phase of your type of business, whether you ever make changes to your methods of operation in an attempt to improve profitability, whether you or your advisors have the knowledge necessary to carry on the activity as a successful business, whether you've been successful in the past in making a profit in similar activities, whether you've seen a profit in some years, whether the activity has produced a profit in at least 3 out of the last 5 years, and whether you can expect to make a future profit from the appreciation of the assets you're using in the activity. And so if you qualify as a business, you can then deduct expenses as an active trader in business. And like I said, our clients typically see between $7,000 and $35,000 per year stemming from these deductions, and they include deductions for things like the cost to set up the business itself, depreciation related to any furniture or equipment that you're using in the business, things that are in your home office. And with a business, you can look back and write off expenses you've paid in the previous 15 months that would have been deductible if you'd been trading as a business, but were disallowed by the IRS because you were being treated as an individual. You can take the cost of using your personal vehicle through the business at a rate of 57 cents per mile, which is up for 2015. Then, of course, any payroll expenses, which include payroll taxes for wages you're paying to yourself or family members, deductions related to providing medical insurance for yourself, contributions to retirement accounts, life insurance, and then also what's called a medical expense reimbursement plan, which allows you to reimburse yourself for any out-of-pocket medical expenses you're paying throughout the year. When you're taxed as an active trader in business, you can actually go ahead and deduct those expenses against trading profits without being subject to that 10% AGI limitation as you would on your individual return. But then as a business, you can also deduct expenses that are more closely related to trading itself. Anything you're paying monthly for dues and subscriptions like platform and data fees, magazine subscriptions, news services, newsletters, newspaper, trading organizations, and even your satellite radio. Then the biggest one we typically see are expenses related to education, anything for home studies, seminars, or trade shows, which would also include travel, hotels, as well as food while you're attending those educational events. Then any expense related to repairing equipment, repairing your home computer, any licenses and permits that you might be required to have on a local or state level, the purchase of new office equipment, such as the purchase of a new trading computer, With a trading business, you can deduct some of your home expenses through that home office deduction. You can deduct bank service charges, office supplies, software purchases, telephone and fax charges, internet, and TV. And of course professional fees such as accounting, bookkeeping, and tax preparation. And any travel and entertainment that's related to the business, which we most typically see come up in the context of education, but for any travel you're doing related to trading, you can deduct that as well. And as with any deduction, the IRS believes that these are a matter of legislative grace, and so they place the burden on the taxpayer to keep adequate records substantiating the amounts of these deductions. And that's really a matter of good bookkeeping practices, just showing how much you're paying for all those various expenses throughout the year. But in addition, the IRS puts the burden on the taxpayer to keep adequate records showing that they are entitled to claim these deductions, essentially keeping adequate records showing that you are entitled to be taxed as a business. So with the tax code, it can really be split up depending on how you're organized. And as an individual, if you're being taxed under that individual tax code, the IRS calls this the investor tax status. If you're being taxed under the business tax code, this is known as being taxed as a trader in securities, also as a sole proprietor. If you're operating your trading through a business entity, on the other hand, you've got a couple other different choices. You can trade through a C corporation, which is a completely standalone business entity, or you can trade through what are called pass-through entities. And these pass-through entities are called that because they pass through items of income and expense to the members. These include the limited liability corporation, which really is the best pass-through entity to use for trading, the S corporation, which really is the worst pass-through entity to use for trading purposes, or the limited partnership, which is an antiquated form of entity to be using for this, but still does offer some benefits to traders that are working through them. And we're going to walk through each of these in turn and talk about just what the IRS is going to be looking at and how they're going to treat you from a tax perspective. So we'll start with the investor. And the investor is generally thought of as someone who's looking for long-term appreciation and dividends for their profits. But this is going to be the default tax status. So if you don't take any steps to improve your tax situation, you're going to be treated as an investor. And from a tax perspective, this is really a pretty terrible place to be. And the biggest reason is that as an investor, you are specifically barred by the IRS from deducting certain expenses as deductions. And these are things like certain types of commissions and brokerage fees, any margin interest in excess of your profits for the year. But the biggest disallowed deduction is education related. And as an investor, you are specifically prohibited from deducting any expense that you're paying that's related to trading education. There are some expenses that you can deduct as an investor, but you can only take them if you itemize, and they're subject to the 2% AGI threshold limitation. So as an investor, even the expenses that you can deduct, you're really limited in the amount that you can actually take as a deduction on your personal tax return. On top of that, there are some pretty major tax issues that face investors, and these are the $3,000 capital loss limitation and the wash sale rules. Both of these are reasons that even in losing years, taxes can remain your single largest trading expense by preventing you from deducting losses in the year in which you actually take them. And that $3,000 capital loss limitation is pretty simple. You can only write off $3,000 of capital loss against your ordinary income in any one year. And to give an example of what that looks like, let's say we've got a trader who's got an ordinary income of $100,000 coming from their day job. Then a terrible trading year showing a capital loss of $100,000. Because of this capital loss limitation, they're left paying tax on $97,000 of income, even though they had that $100,000 loss, leaving this taxpayer with a suspended capital loss of $97,000. This is carried forward into future years, but you're going to be facing that same $3,000 limitation year after year to take that against ordinary income. Then we have the wash sale rules. And the wash sale rules really are a headache. They're a headache to explain, they're a headache to keep records for, and they can be a serious headache when they cause you to pay a lot more in taxes than you should be. But a wash sale occurs when you sell a security at a loss, and then within 30 days, either before or after the date of that sale, you purchase that same security or a substantially similar one. And for the purposes of a substantially similar security includes any option that's on the same underlying stock, and then also trading that's being carried out in a retirement account like an IRA. But when a wash sale occurs, the loss on that sale is disallowed, and the base and replace stock is adjusted to take accounting for that loss, essentially carrying your loss forward into future months or future years. But to give an idea of what this one looks like, we've got a trader who owns Microsoft with a basis of $25 a share. And a year, when Microsoft is trading at $23 a share, they go ahead and sell it to recognize that loss of $2 a share. But if they get back into Microsoft on January 1st of 2000, because that repurchase is within 30 days, no rules come to play. So with this, that loss in 2013 is disallowed, and the basis in that newly acquired stock is adjusted to take accounting for that loss. And as I said, this is a very big headache to keep track of, especially if you're in and out of the same for a couple of stocks regularly. But in a case like this, your losses can do a future year. If this is something that you don't pick up on, the IRS can take a look at this and require you to file an amended tax return for 2013 and pay a fine on that tax you should have been paying. In one of the tax court cases that we'll take a look at, the IRS took a look at a trader's return and ended up causing him to show $400,000 of profit in a previous year because he hadn't properly with the wash sale rules. But between these wash sales and the $3,000 loss limitation, this is really why that even if you're losing money trading, taxes are your single largest trading expense. So that was the investor, the individual being taxed under the individual tax plan. Now we're going to go to traders, the individual who's being taxed as a business. And as a business, all of those expenses I ran through earlier. However, there are some concerns about trader's tax status. If you want to use it, there's no election necessary. You simply file Schedule C with your 1040 tax return at the end of the year and deduct all of your trading businesses. And that's $7,000 to $35,000 a year that I mentioned earlier. But trader and securities tax status, we don't typically like to file it because there's concerns. The biggest of which is that there's nothing in the tax code about just what a security actually is. Instead, we go to the IRS publication 550, just the rules for traders and securities, and tax court cases. On top of it, if you're operating through a Schedule C, you're going to be audited much more often than individual investors or traders who are working through formal business entities. Just due to the nature of the IRS audit process, filing as a Schedule C subjects you to a much higher audit for your trading purposes. But in the publication 5, look at the special rules for traders and securities. And they define a trader in securities, one who is seeking to profit from daily market movements in the price of securities and not from dividends, interest, appreciation. That a trader in securities has substantial activity in them, and that a trader in securities carries on this activity with both continuity and regularity. Unfortunately, they don't give us hard rules on just this look. Instead, much like that initial determination of whether you're going to be taxed as a business, as a hobby, they give us facts and circumstances to consider in order to whether or not you meet those 3 requirements. So in order to tell if you're looking to profit daily changes in market price, they look at the holding periods for the securities that you're buying and selling. In order to have substantial activity, they look at both the frequency and dollar amounts for your trades during the year. And in order to check if you're trading with both continuity and clarity, the amount of time you're devoting to the activity. But this is really all they tell us. Tell us what holding periods you can use to qualify, just how many trades or how much during the year, or how much time you need to put towards trading these questions. So to get a little bit better picture and some hard numbers, we turn to tax court cases. And we've got 4 cases that we really look at for guidance on the trading securities tax. In Chen v. Commissioner, which is really the first case that we have security status, we had a trader who had more than 300 trades during the year in question. But the IRS disallowed his trader in securities tax status because those 300 trades started over a month period at the beginning of the year. And in the other 9 months of the year, he didn't do any trading whatsoever. In addition, he'd made an election that was only available to traders to keep him properly, indicating that he didn't know just how to operate that as a successful business would. But because of this, they disallowed 1,000 in deductions, leaving him with a pretty ridiculous tax bill. The Commissioner was a case where we had a husband and wife team trading together, and in the year in question, they again had 300 trades. But the IRS determined that trades were all long-term in nature, or rather longer-term, traders for most of the year. On top of that, they were trading on less than 50% of the trading, and were trading entirely in personal accounts rather than trading through an entity specifically set up to be a trading business. And so based on those factors and the lack of continuity in their trading, their trader in securities tax status was disallowed. KV Commissioner was a case where the trader had filed as a trader based on the dollar amount for the trading he was doing throughout the year. This gave about $20 million worth of trades, but that $20 million worth of trades was not enough to qualify him. That $20 million was spread out over about 84 acts, and because of that lack of trading, his trader in securities tax status was allowed. Then we have the most recent case of Endicott v. Commission, and in this case, we had a trader who had over 1,000 trades during the year in question. Trading occurred continuously throughout the year itself. But the IRS disallowed the trader in securities tax status because of the fact that he had some substantial long-term positions that were the same. He was trading with that frequency, showing that he wasn't looking to profit from changes in market price, but rather from capital appreciation. So from 4 cases, we really learned that no single factor is going to be enough. In order to qualify securities, you really do need to meet all 3 of those circumstances. Your trading position held on a short-term basis, and you need to be trading on more than 50% of the trading days throughout the year. Working with traders, we found that trading on 10 of the trading days is really what the IRS is looking for, and having more than 300 trades is really a pretty good place to be. So with these factors, you've got a pretty serious decision to make. Whether or not you should be taxed for securities or as an investor. And with this decision, you have to weigh the benefit, being able to deduct those trading expenses that I mentioned earlier against the cons, the uncertainty of and the increased frequency of IRS audits for traded securities. Or to sidestep this, and instead of being taxed as a trader in securities, you can operate a trading business. And these businesses, again, the limited partnership, which is okay to use for trading. The S is really the worst pass-through entity to use for trading purposes, and the limitability corporation, which is really the flow-through entity of choice for trading purposes. And like LLC, primarily because it's a creation of state law rather than federal, which gives it some increased flexibility for just how the IRS is going to tax it. And with an LLC, what we're looking for is a partnership tax treatment. Just those tax advantages from the partnership that I mentioned earlier, but with an LLC, you also gain liability protection. But with an LLC, we refer to the owners as members, and the management of the LLC can be spread out over all of the members, be collected one managing member, typically the trader, who would also be doing the day-to-day bookkeeping, bill paying that for the LLC. Ability does mean that if you have a single member LLC, it will be treated as a disregarded entity. You would file a Schedule C and have the same issues as that trader and securities file LLC. So for a trading LLC, we do recommend having at least 2 members. The second member can be your spouse or another family member, and it can also be a separate entity, like a corporation or even an irrevocable trust set up specifically to be the second member of that LLC. But then inside that you have a situation where the LLC pays no tax. All of the profits from and all of the expenses associated with trading are instead passed through to the members. And passed through, they get the same characterization of income. Capital loss, 6 gain and loss if you're working with futures contracts, binary options, things of that nature. Gain and loss if you're working with Forex. And then expenses come as ordinary. The best part about operating through an LLC is that you're able to deduct those expenses as ordinary expenses. The profits come through with no payroll paying owed. So with an LLC, you really get the benefits of operating as a business without payroll tax. The other option I mentioned was trading through a C, and that C corporation is a complete standalone entity, which means its own taxes, but it pays these taxes at a much lower rate than you and I do. 15%, $50,000 of profit. In addition, it has some special tax rules that provide additional benefits to traders and is considered to be a business as soon as it's set up. But these special tax rules are all related to the benefits that the corp can offer you. And these include being able to pay yourself and your family members a wage, and based on that wage, make contributions to retirement accounts for yourself and members. With a 401k sponsored through the C corporation, you can get $53,000 into a retirement account, and in that retirement account, use that as well. But then one of the biggest benefits is the medical expense reimbursement plan. And the C corporation, you can use this to really supplement whatever personal health insurance you place. With the medical expense reimbursement plan, any out-of-pocket medical expense you can deduct that through the corporation. And when it's deducted through the corporation, you take those expenses 100% against trading profits. Whereas if you were to take those two, it would be subject to the 10% AGI limitation. So just by corporation in this case, you see a pretty substantial increase in the medical expenses that you can't deduct. The only real downside to a corporation is that may end up some payroll tax on profits that you're pulling out of that corporation. So around that, you can operate through what's called a combination entity. And with a combination entity, we have a corporation that was owned by yourself and your family. This corporation would be in existence to provide benefits, to pay the expenses of the LLC, reimburse you and out-of-pocket expenses, and make retirement account contributions on behalf of you and your family. The corporation would be one of the owners of a trading LLC, and the other owner, the actual trader. And this LLC would exist solely to generate profits, passing just enough income up to the corporation to provide those benefits and pay for those expenses, wanting the remainder of those profits out to the trader with no payroll tax due on those profits. So by operating with the combo entity, you really can maximize your tax savings. And we suggest using these business entities because of you to deduct trading expenses without worrying about those special rules for traders in the IRS Publication 5. It also allows you to go back at least 12 months and recapture business expenses that you've paid in that period that you otherwise would not be able to deduct. You bring those expenses forward into the newly created business and deduct them against future. By operating through these business entities, you really can maximize, and by doing so, leaving you more money to trade with throughout the year. And with these businesses, you can take advantage of the perks, being paid for through the business entity and deduct them through that method, as well as being able to deduction of using your home for the business, deducting a certain percent of your electric, gas, sewer, expenses of that nature through that home office deduction. Beyond that, by operating through a business entity, you really can isolate your personal assets from your trading assets, giving you some protection against any sort of investment against you. So this will serve the two paths to profit. On the left, we have trading being taxed as an investor, and as an investor, you're going to be paying more in taxes, so you move slower towards that goal of profit. The way you can run into some pretty serious issues with both the $3,000 capital loss limitation and the rules. On the right, we have trading inside of a business entity, trading being taxed business. And by doing so, you'll be paying less in taxes, leaving you with more money quicker towards your goals of profit. And along the way, you can take steps to avoid issues that are capital loss limitation and the wash sale rules. Through a couple of different options in terms of how you can carry out your trading. Which one is going to work best for you is very dependent on your personal tax situation. And so we're doing a free 30-minute consultation with one of our business development consultants here at Accounting. That's your personal tax situation and which of those business structures that I just ran would be the most tax efficient for you. And if you're interested in signing up for this 30-minute consultation, please email me at learn@tradersaccounting.com and we can get you set up for that free consultation. We've talked about trading as a business from a tax perspective. Now we're going to go about how you need to get started. And who you have create the business entity trading purposes does make a difference. Anyone can start their own. You can go to pretty much any website out there and use them to create your business entity. There are some decisions that need to be made with the creation of a business entity that directly impact trading and taxes. And so we do suggest making sure your incorporator understands trading. And we would very much like to help you set up any of the entities or structures that we've discussed today, and do have a plan in place that ensures your success, which includes continuing coaching, walking through the process, and making sure that along the way there are no missteps. But the most important decision that you can make when you're creating one of these business entities relates to just how traders are taxed. And by default, you're looking at the capital gains taxation. Anything you hold more than a year is going to be taxed at the long-term capital gains rate, which is either 0, 15, or 20%. Anything you hold less than a year is taxed as short-term capital gains, which is taxed at just your ordinary income tax rate. But there are types of trading out there that get different tax treatments. The most interesting of which is going to be the hybrid 1256 contracts. These are things like futures, binary options, any sort of non-cash settled option, as well as Forex trades that you've made the proper elections for. And when you're setting up that business, you have the option to make what's called the mark-to-market election. which changes how your trading is going to be taxed, and really can make or break your trading business, because it has the effect of changing your capital gain and loss into ordinary income and ordinary loss. This means that with the mark-to-market election in place, you don't have to worry about that $3,000 capital loss limitation. Instead of being limited to $3,000 a year, your losses from trading would be deducted 100% against ordinary income. On top of that, with the mark-to-market election in place, the wash sale rules would not apply to you. So by making this mark-to-market election, the two biggest tax issues that face investors, you've completely gotten rid of them. There are some very specific rules on when and how to make this election, and really the easiest and best way to do it is with the creation of a new trading business. And this is the biggest reason we suggest working with someone who understands trading when you're creating any sort of business entity. But there are a couple of types of traders that want to avoid the mark-to-market election. And the first group are those that's working with futures and broad-based index options, as well as binary options and a couple different kinds of contracts. But these are called Section 1256 contracts, and they're taxed as 60% long-term capital gain and 40% short-term capital gain, regardless of your holding period. The filing with these contracts is a little bit easier. You report the net gain or loss for the year, rather than having to list out each trade as you would with standard tax reporting. And they are also essentially mark-to-market. So any open positions at the end of the year are considered to be closed, and as if you'd reopen them on January 1st with the same basis. You get 3 years to carry back losses and 5 years to carry forward losses with these 1256 contracts. And the mark-to-market election is typically not made by these traders because they don't really gain any benefit, and by doing so, they lose the positive benefit of that 60-40 long-term split. Then the other group that typically avoids that mark-to-market election are those that work with Forex. And that's because Forex is taxed under yet another code section, Section 988, which gives the Forex ordinary income, ordinary loss to begin with. So already as a Forex trader, you don't have to worry about those issues with $3,000 capital loss limitation or the wash sale rules. On top of that, you can make an election to have your Forex trades treated as if they were Section 1256 trades, being able to pay that lower 60-40 tax rate on your trading profits. But as opposed to that mark-to-market election, which is made for all of your accounts, the Forex 1256 election is made on a trade-by-trade basis. And again, the mark-to-market election is typically not made by these Forex traders because by doing so, they lose the ability to convert the 988 trades to Section 1256 trades, and so cut off the ability to pay less in taxes on their trading profits. So that's really going to finish the substantive portion of my presentation. Again, at Traders Accounting, we can help you with everything that I've discussed today, setting up these business entities, coaching to ensure that you're operating them properly, as well as tax preparation, monthly bookkeeping, and then help with setting up a retirement account funded by your trading profits, and a family living trust to take care of your estate planning needs. Looks like I'm running up on my allotted time, and so I'll quickly run through these last two trades, or last two slides rather. But with a self-directed 401k, it does give you some great options to really fund your retirement account from trading profits. And with a self-directed 401k, you do have some very substantial options in terms of just how you can invest. And with this self-directed 401k, pretty much the only thing you can't invest in is going to be sports memorabilia. But you can do things like margin trading and futures trading inside of a self-directed 401k. And in 2015, you can contribute up to $53,000 to a regular 401k, and then $18,000 into a Roth 401k. But so this is my last slide, and I save it for last because it really is the most important slide I have. If you don't have a tax preparer that understands traders' taxation, everything else I've discussed today is pretty much worthless. And so we do suggest finding a tax preparer that understands just how traders are taxed. And to get an idea of just how familiar they are with traders' taxation, we suggest asking them, what is the mark-to-market election and how do I make it? What are wash sales? And then how are Section 1256 contracts taxed? But please keep in mind that you can use traders accounting for any of your tax preparation needs. But that's going to finish up everything that I have to talk about today. If you'd like some handouts, including my presentation slides, expense sheets listing the various expenses that you can deduct as an active trader in business, more information on IRAs and business or hobby distinctions with this trading, please email me at learn@tradersaccounting.com.